It began not with a crash, but with a slow, imperceptible leak. I was living a life of managed decay, though I would have never used those words at the time. To the outside world, and more importantly to myself, I was functional. I held a respectable mid-level marketing position at a firm that was neither flourishing nor failing. My wife, Elena, and I lived in a perfectly acceptable two-bedroom apartment in a neighborhood that was safe, if uninspiring. We had one car, a sedan that was perpetually 2 years away from being paid off. We were, by all standard metrics, fine. This was the facade, and I was its chief architect and most devoted believer. The reality, the one that hummed beneath the surface of every decision, was a fragile ecosystem of plastic and promises. My credit was not catastrophically bad. It was perennially mediocre, hovering in that murky territory that lenders euphemistically call subprime. It was a number that granted just enough rope to hang yourself, repeatedly. My financial life was a precarious ballet performed on a tightrope of minimum payments. I had mastered the rhythm of due dates, not as a strategy for prosperity, but as a survival mechanism. The primary instrument in this orchestra was a collection of 4 credit cards, each serving a specific grim purpose. The emergency card, its limit long ago maxed to cover a real emergency, a root canal my dental insurance deemed cosmetic, now carried a permanent balance that bled $47 in interest every month. The gas and groceries card was my transactional workhorse, perpetually floating at 80% of its limit, its statement a monthly reminder of the cost of simply existing. The other 2 were relics of younger, dumber days, kept barely active with a small annual charge, their low limits a monument to past mistakes. I had become an expert in a psychological practice I now call justification arithmetic. The 22% APR on the car loan? It's the price of reliable transportation, I would tell Elena, omitting the part where my score guaranteed we'd never see a single-digit rate. The mandatory security deposit for our utilities, equivalent to 2 months of service? Everyone pays that, I'd shrug, ignoring the fact that our friends with good credit did not. The most insidious cost, however, was the psychological toll. Every significant purchase was preceded by a silent internal inquisition. Could we put it on the card? Which one? How close was it to the limit? What would the utilization do to my score? A score I checked with a mix of dread and obligation every month on a free monitoring site. Consumption was no longer about desire or even need. It was a complex moral and logistical calculation that drained the joy from anything it touched. The tightrope vibrated most intensely during moments of minor ambition. We once saw a beautiful garden-level apartment for rent, just a few blocks over in a leafier part of town. It had a small patio. I remember Elena's face lighting up at the idea of morning coffee outside. The application fee was $75 per adult. As I filled out the forms online, a cold sweat broke out on my neck. I knew what was coming. The approval would be pending further review. The property management company would run their check, and the invisible wall of my credit history would rise up. 2 days later, the polite, automated email arrived. While we appreciate your application, we are unable to offer you tenancy at this time. We encourage you to reapply in the future. The unspoken suffix, when you are a better financial candidate, hung in the air. I deleted the email. I told Elena they'd already rented it to someone else. The lie was easier than the confession. That patio, that simple dream of sunlight and coffee, was sacrificed to the 3-digit god I refused to properly acknowledge. I constructed an entire worldview to sustain the facade. I cultivated a cynical disdain for the system. I would mutter about how credit scores were a tool of control, a way for banks to keep the little guy down. I found solace in articles arguing that millionaires often had average credit. This was not insight. It was intellectual camouflage for my inaction. I conflated being anti-establishment with being financially irresponsible, a comfortable delusion that allowed me to feel shrewd rather than negligent. The most dangerous aspect of this life on the credit tightrope was not the occasional fall, the declined application, the usurious interest, but the normalization of the sway. The constant, low-grade anxiety became my baseline. The background hum of financial insecurity was the soundtrack to my life, so ever present I forgot it was playing. I had adapted to living in a cage whose bars were made of my own poor decisions and maintained by my refusal to look at them directly. I was not living, I was balancing, and I was one strong gust of wind away from discovering just how far the fall could be. That gust was coming, and it would not be financial. It would be profoundly, devastatingly human. But that revelation was still ahead of me. For now, I kept walking the wire, convincing myself I was a skilled performer, blind to the fact that the net below had long since rotted away. The gust of wind arrived on a Tuesday afternoon in late October. It was not an abstract financial shock, not a market crash or a sudden job loss. It was a pediatrician's clinical, empathetic diagnosis delivered in a softly lit examination room decorated with cartoon animals. Our daughter, Lily, then 7 years old, had developed a severe, persistent asthma. The allergist confirmed it was directly linked to the pervasive mold in our apartment's aging ventilation system, an issue our landlord had previously dismissed as minor condensation. The prescribed treatment was unambiguous. A change of environment was not a matter of comfort, but of medical necessity. Her lungs required clean, dry air. The urgency was a physical weight in my chest, rivaling the tightness I imagined in hers. This was no longer about a sunlit patio or a nicer neighborhood. This was about the fundamental safety of my child. For the first time, my financial management was not an internal dialogue about convenience or desire. It was the singular barrier between my daughter and her ability to breathe freely. We found it quickly, a modern, well-maintained complex in a neighboring suburb, renowned for its excellent air quality and top-rated school district. The unit had new HVAC, hardwood floors instead of carpet, and large windows. It was, in every sense, a sanctuary. The rental agent, a kind woman named Sarah, saw the desperation mingled with hope on our faces. "You're exactly the kind of family we want here," she said warmly, handing me the application. I filled it out with a trembling hand, the pen feeling like a surgical instrument. I included a letter from Lily's doctor, a notarized statement of employment, and bank statements that showed just enough stability to maintain the facade. I paid the non-refundable $120 application fee, a sum I knew would hurt, with a silent prayer. The 48-hour wait was a study in cognitive dissonance. I vacillated wildly between manic optimism and profound dread. I researched asthma-friendly decor. I measured Lily's new room in my mind. I also refreshed my email obsessively, my pulse spiking with every notification. Elena remained stoically hopeful, but I saw the shadow in her eyes when she thought I wasn't looking. The response came at 4:17 p.m. on a Thursday. The subject line was innocuous: application update, the Oaks at Riverbend. My heart did not sink. It simply stopped. The blood seemed to drain from my extremities, pooling somewhere cold in my feet. There was no preamble. The first line was a polite digital guillotine. "Dear Mr. and Mrs. Carter, thank you for your application to the Oaks. After a thorough review, we regret to inform you that your application has been denied at this time. This determination was based in whole or in part on information obtained in a report from the consumer reporting agency listed below." The words that followed, the Fair Credit Reporting Act disclosures, the agency's contact information, blurred into a gray smear. The legal language was a sterile wrapping around a core of profound personal failure. The letter was not a rejection of our paperwork. It was a revocation of my agency as a father and a protector. It stated, in the calm, unassailable logic of an algorithm, that my past financial carelessness now outweighed my present parental responsibility. That the risk I posed as a borrower was greater than the medical risk to my 7-year-old child. I read it 3 times, standing in the kitchen, the afternoon sun streaming incongruously through the window. The sound of the world did not fade so much as it transformed into a high-pitched, metallic ring. I was aware of Elena entering the room, her voice asking, "What is it?" from a great distance. I was aware of Lily's laughter from the living room, a sound that now felt like an accusation. This was the moment. The abstraction was dead. The number was no longer a number. It was the landlord's polite, "I'm sorry." It was the mold in the vents I couldn't afford to escape. It was the look of crushed hope on my wife's face as she took the letter from my numb fingers. It was, most devastatingly, the act I would have to perform next. Walking into the living room, kneeling before my asthmatic child, and explaining that we could not move to the home that would help her breathe because her father's credit was broken. In that crystalline instant of shame, the true cost was illuminated with searing clarity. Credit was not about loans or rates. It was about choice. It was about the power to say yes to safety, to health, to opportunity when life demanded it. I had surrendered that power years earlier, transaction by transaction, excuse by excuse. I had believed I was managing a score, when in reality, I was negotiating away my family's sovereignty. The tightrope had snapped, and I was not just falling financially, I was failing, utterly and completely, in my most basic role. The facade was gone, shattered by the sound of my daughter's cough in the next room. All that remained was the undeniable, terrifying reality of the wreckage, and the profound, suffocating question of whether I could ever rebuild. The week that followed the denial was a state of psychic paralysis. The initial shock hardened into a thick, debilitating shame. I moved through my professional and domestic duties as an automaton, the letter from the Oaks a phantom weight in my briefcase. The platitudes of popular financial advice, when I could stomach looking at them online, felt like a cruel joke. Create a budget. Pay down your highest interest debt first. These were the instructions for repairing a leaky faucet, and my entire house had just collapsed into a sinkhole. They addressed the mechanics while ignoring the profound emotional and systemic dysfunction that enabled the disaster. I needed something deeper, a foundational restructuring, not just of my finances, but of my relationship with money itself. The true beginning of my comeback was not a spreadsheet, but a conversation. It was the most difficult action I have ever undertaken. One evening, after Lily was asleep, I asked Elena to sit with me at our kitchen table. I placed the denial letter between us, a silent prosecutor's exhibit. Then, I did not present a plan or make promises. I performed a confession. I logged into every account, checking, savings, and the 4 credit cards with their alarming balances. I projected the statements onto our television screen, forcing us both to witness the unvarnished truth. I narrated the story of each balance, the impulsive purchase, the deferred emergency, the months of neglect. The room was silent, save for the hum of the refrigerator and the quiet clicking of the keyboard. I saw the hurt and fear in her eyes, but I also, for the first time, stopped hiding from it. This act of radical transparency was the demolition of the final wall I had built. It was the essential prerequisite. We could not rebuild on a foundation of secrets. From that scorched earth, our strategy emerged. It was not found in a single book, but synthesized from fragments of non-traditional advice, psychological insight, and brutal trial and error. We abandoned the conventional debt snowball in favor of what I termed strategic triage. We listed every debt not by size or interest rate, but by its psychological burden and its impact on our credit profile. A small, forgotten $120 medical bill that had gone to collections was prioritized over a larger credit card balance. Why? Its status as a collection account was a catastrophic red flag on my report, a single black mark outweighing 100 small grays. We saved for a month and paid it in full, requesting a pay-for-delete agreement in writing. Its removal provided our first tangible jolt of progress. Simultaneously, we attacked the core issue, credit utilization. The general advice is to keep it below 30%. We aimed for below 7%. To achieve this, we transformed our credit card usage into a precise weekly ritual. Every Friday evening, I would pay down the current balance on every card to a single digit, regardless of the due date. This ensured that whenever the issuer reported to the credit bureaus, typically on the statement closing date, the balance shown was negligible. This tactic did not require more money. It required more vigilance. It manipulated the reporting mechanism to our advantage, creating the illusion of pristine management, and, over months, transforming that illusion into reality. The most unorthodox move involved seeking new credit while still in significant debt, a heresy in traditional advice. I researched and applied for a secured credit builder loan through a local community credit union. For 12 months, I essentially paid them a small fee to hold $1,000 of my own money in a locked savings account while making monthly payments reported to all three bureaus. It was a performance of creditworthiness, and it worked. This trade line added a layer of positive, diversified history my profile desperately lacked. Perhaps the most critical component was the mental recalibration of velocity. I stopped thinking in terms of months and began thinking in terms of reporting cycles. A payment reported on time was good. A balance reported as low was better. But stacking multiple positive reporting cycles in quick succession by micromanaging due dates and payment dates created a compounding effect. The algorithm perceived not just improvement, but rapid, consistent rehabilitation. We were not just fixing a number. We were communicating a new narrative to a robotic audience. This process was devoid of glamour. It was a grinding, monotonous exercise in discipline. It meant forgoing any non-essential purchase for over a year. It meant that at every extra dollar had a pre-assigned destination before it even arrived. It meant the constant, humbling confrontation with my past mistakes. There were setbacks, an unexpected car repair that temporarily spiked the card's utilization, the frustrating discovery of an old account I had forgotten to close. The climb was not linear. It was a jagged upward trend punctuated by discouraging plateaus. Yet, within this grind, a subtle shift occurred. The anxiety that once came from ignoring my finances began to be replaced by the empowerment of controlling them. Each small victory, a collection deleted, a credit limit increased due to good behavior, a 10-point score bump, was a brick in a new foundation. We were no longer balancing on a tightrope. We were down in the dirt, laying a path, one painful, deliberate stone at a time. The goal was no longer just a new apartment. It was the reconstruction of a fundamental pillar of my life, trust. In myself, in the process, and in the possibility that the past did not have to be a permanent sentence. The fall had ended. The arduous, uncertain climb had begun. The transformation was not marked by a parade or a dramatic letter of congratulations. It was quiet, almost anticlimactic in its simplicity. The first real sign was an email notification I received one ordinary Tuesday morning, 18 months into our disciplined march. It was from the issuer of my oldest credit card, the one with the once maxed limit and the crushing interest rate. The subject line read, "Good news about your account." With a familiar, defensive clench in my stomach, I opened it, expecting some new fee or a change in terms. The message was brief. Based on your responsible account management, your credit line has been increased. No hard inquiry. No request. It was a unilateral, automated acknowledgement of behavioral change. That increase by itself lowered my overall credit utilization ratio by a full 5 percentage points overnight. It was a small mathematical adjustment with a profound psychological impact. The system was no longer just punishing me, it was beginning to reward me. This was the new reality of fixed. It wasn't a destination where all problems vanished. It was the acquisition of a new set of tools, and more importantly, a new sense of agency. The moment of true arrival came not when we qualified for a luxury card, but when we faced a major unavoidable expense. Our refrigerator, a veteran of the old apartment, finally shuttered and died. 2 years prior, this would have triggered a crisis, a scramble for a high-interest store card, a desperate raid on a meager savings account, or a descent into a predatory loan. Now, I conducted research. I compared models. And I applied for and was instantly approved for a card offering 0% introductory APR for 18 months on purchases. We bought a reliable, energy-efficient unit. The payment plan was structured, deliberate, and cost us not a single cent in interest. The crisis was managed not with panic, but with strategy. The credit, once a source of peril, had become an instrument of calm resolution. The ultimate test, of course, was re-entering the arena where we had been most decisively defeated. When a job promotion for Elena made relocation to a different state a compelling opportunity, we had to face the rental market once more. The process was eerily similar. The online searches, the applications, the background checks. But the emotional landscape was entirely different. There was no cold sweat, no whispered prayers over the non-refundable fee. When the approval for a beautiful modern rental home came through within hours, accompanied by a welcome email instead of a legalistic rejection, the feeling was not euphoria, but a deep, resonant calm. We had not won a lottery. We had earned an outcome. The barrier had been removed, not by luck, but by our own sustained effort. This is the redefinition I now understand. A good credit score is not permission to consume. It is optionality. It is the preserved capacity to say yes to life's necessary and beautiful opportunities, a safer home, a reliable car, an educational pursuit, a managed emergency, without financial trauma. It is the eradication of the background hum of anxiety that once scored my daily life. The energy I once expended on justification, arithmetic, and shame management is now freed. My relationship with money is no longer emotional. It is operational. It is a quiet, confident competence. My identity is no longer tied to a number, but the number now accurately reflects a changed identity. It speaks of reliability, not because a bureau declares it, but because I have lived it. The comeback was never about achieving a pristine 850. It was about crossing the threshold from being controlled by my past to being empowered in my present. The shackles were not broken by a single heroic effort, but filed away, day by day, through 1,000 small acts of integrity. The man who trembled at a rental application is now a curator of his own financial destiny. The silence in my life is no longer the quiet of dread, but the peace of stability. The cage is gone. I am not just living, I am choosing. That moment in my daughter's room, kneeling on the carpet that likely held its own particles of mold, was the absolute nadir of my life as an adult. It was the point where the abstract consequences of my poor decisions became a tangible, heartbreaking reality in the form of my child's health. The shame was total. It was also, I now understand with perfect clarity, the most necessary moment of my life. It was the violent, non-negotiable end of ignorance. I could no longer hide behind cynicism or blame a faceless system. The system had spoken, and its verdict was that my past made me an unacceptable risk for my daughter's future. I was forced to look into the mirror of my own negligence. That reflection was unbearable. But from its fragments, I began to rebuild a truer self. This journey taught me that credit repair is a misnomer. You are not repairing a number. You are conducting a forensic audit of your past choices and then systematically building a new evidentiary record of responsibility. You are not just communicating with lenders. You are sending a revised transcript of your character to a network of algorithms that govern modern opportunity. It is a psychological rebuild first, a financial one second. The discipline required does not simply affect your balance sheets. It recalibrates your relationship with time, with impulse, and with future security. My story is a single data point. It is proof of concept that a fall is not final. But my path is not a universal blueprint. The financial landscape is complex and constantly shifting, with new regulations, reporting nuances, and financial products emerging. What worked for me in my specific circumstances, the strategic triage, the cycling of payments, the use of niche credit builder instruments, must be understood as principles, not prescriptions. The core truth is universal. Inaction is a choice with compounding interest, and that interest is always paid in lost options, elevated stress, and compromised dignity. This realization and the arduous process of my own comeback is why Credit Comeback Stories exists. This channel is not another source of generic, recycled financial tips. It is a dedicated space for the granular, the unconventional, and the real. We deconstruct the psychology of debt and the architecture of credit scoring. We analyze strategies for navigating specific, daunting challenges, from the implications of the latest medical debt reporting changes to building a robust profile as a new immigrant, from the strategic considerations of settling old debt to understanding how to leverage authorized user status effectively and ethically. We go beyond the what to explore the how, and most importantly, the why. Each video is designed to provide you not just with information, but with the actionable intelligence and the motivational framework to author your own turnaround. If my story resonated with you, If it triggered a flicker of recognition, a pang of anxiety, or a spark of determination, then that is your signal. That is your version of my moment in the pediatrician's office. Do not ignore it. Subscribe to Credit Comeback Stories today. Click that notification bell. We are building a community focused on empowerment, not shame, on strategy, not shortcuts. Your journey back to financial agency begins with a single, deliberate click. Let our deep dives into credit law, psychological tactics, and real people case studies be your guide and your catalyst. I will see you there. And remember, this is not about a score. It is about the narrative you choose to write from this day forward. It is about your comeback.